there you go. I mean, needless to say, Sensex and Nifty do not matter because first HDFC Bank matters. Let's look at HDFC Bank and then we look at the derived impact of HDFC Bank, because HDFC Bank now after the merger has a combined weightage. You know, even our screens are slightly lazy today. That's largely because when HDFC Bank falls by 5-6%, our screens also, they take time actually to load up. So just bear with me.
6%.
It's a 6% drop, and this is a good enough reason why markets today in a sense would be in a very shaky kind of a move. Can we have the intraday graph or you maybe the wall graphic? There you go. HDFC Bank 6% down and the breadth of the market is completely dented. It's like saying that, you know, 12 घंटे में दुनिया बदल गई है, right? I mean, the world has taken a complete 180-degree turn. Suddenly for the market breadth, for the tone and tonality of the market, and there is just a lot of red on the screen. Nobody saw this kind of an coming, and one stock can really cause this kind of an collateral damage. So it's a shaky Wednesday morning. The hit has come from an unexpected pocket and it is having impact on the market mood, sentiment and just about everything.
Yeah, absolutely. And you know, it's bearing not just on the Nifty, which has cracked 1%, but look at the Nifty Bank. That is the, you know, rate that we should actually bring up, because the Nifty Bank has fallen nearly about 3%. And more than HDFC Bank, look at the rub-off on the other earnings contenders this week. Remember, you've got ICICI Bank and Kotak both reporting their numbers come Saturday. ICICI Bank is also just about defending that 1,000 rupee mark, and Kotak Bank also is lower by about 1.25% as we speak. Reliance, though, it's holding around 0.5% in the green or so, which is why the index is getting that little bit of support. But today, of course, you've got LTI, Mindtree, you've got Asian Paints both reporting their numbers. So those are going to be some of the other stocks which are going to be in focus as well. Let's see what ICICI Lombard, ICICI Securities are up to. Both of them came out with their numbers. ICICI Lombard gaps up about 3.25%. The underwriting loss is actually reduced by 4%, so that's something that the street is liking. For GMR Airports, the December passenger traffic has seen an uptick of 15.3%. Aircraft movement as well on a year-on-year basis has started off well in the green. And while HDFC Bank alone has contributed a good 100 points to the Nifty decline, some of these stocks like a Reliance Industries, for instance, is giving some sort of support. A bit of a lift off from the lows. Now HDFC Bank is down 5%. But still, it's quite a sharp fall. Adani Energy, Piramal Pharma, DCB Bank, these are the other stocks that I want to revisit. What Godrej Properties as well is up to. They've acquired that additional 1 acre of land as well in Bangalore. Adani Energy lower by about 0.5%. Godrej Properties down 0.5%. Piramal Pharma, DCB Bank, they're all going to come up for you on your screens next. We'll have Piramal Pharma, which has launched a new concentration of zinc sulfate for injections in US. That stock starts off 1% higher. But DCB Bank, I don't think it's really seeing any bit of green right now. It's still lower by about 0.7%. The new MD and CEO who's going to take over, the names got announced come April 29th. So that's another stock which is going to be in focus this morning as well. But I think today it's really all about HDFC Bank. 5% lower, Nikujan last check.
So Aisha, is the cut in HDFC Bank going to be, jamming the market in terms of an upward momentum? When you see one heavyweight, which 14-15% weightage, suddenly going on the other side and going very swiftly, it may just restrict the upside for the market. So mentally, you will now soon see a narrative until unless any other heavyweight fires in. Reliance has already given you the 10% spike. IT stocks have seen a bout of short covering. So what next in the near term which will drive the index higher? I think that is where the debate will start. And if that debate will start, then the traders would say, okay, the index upside is capped and then there is budget. And after that, there are elections. So what happens to mid and small cap stocks? I mean, will money move back into small and mid cap stocks, or because the index is looking capped, that could actually see some kind of unwinding in mid and small cap stocks? Let's see how it moves. I mean, I've been maintaining this view that January will be a difficult one to call, purely looking at seasonality. And after the October, November, December run up, you have to keep your expectations low. But our market's overreacting to HDFC Bank numbers. Let's understand that. And I've got Saurabh Mukherjee. He's been owning, investing, and he's been advocating to his clients and to our viewers that franchise like HDFC banks are rare to find. But when Like Buffett has always said that when good businesses go through a temporary lull, that's the best time to buy, right? So Saurabh Mukherjee, I thought I'll ask you on markets. I thought I'll ask you on mid caps, but when HDFC Bank falls by 5%, that has to be the first question.
And it tells you a lot about the world that a bank of this scale can report 20% growth in loan book, improvement in asset quality, and still fall 5%. I found the results to be solidly reassuring. I appreciate that some people are worried that the deposit growth isn't as high as expected, but my reckoning is that will come through. Sashi Jagdishan reiterated that this fiscal they'll set up 1,000 branches. I know that the previous target was 1,400. I reckon they'll get back to that number. Just to put 1,400 branches a year, opening 1,400 branches a year into perspective, a well-run regional bank like Federal Bank has all of 1,400 branches, right? So Federal Bank is a good bank. They have 1,400 branches in total. What HDFC Bank is aiming to do is set up 1,400 branches every single year. This year, they seem to be on track for 1,400. Operationally, the bank is in good shape. Deposit growth, whilst less than what market was expecting, is still on an incremental CASA basis. They're pulling in 15% of India's CASA, which I think is very impressive. So we remain happy with the position. We think something like 8-9%, perhaps even close to 10% of our flagship product is HDFC Bank. And we'll stay invested, perhaps look to buy a bit more, given that it's trading on 20-year lows on price to book.
But the challenge with the HDFC Bank is that just like you like it, everybody likes it. And when everybody likes a stock, the appetite to buy into that stock perhaps could be limited and restricted, while 20% growth is enviable. This kind of expansion is admirable. But some would say that, everybody is not fully invested in HDFC Bank. Everybody, in a sense, is now swimming, and some are also drowning in HDFC Bank. It's like a stock which is consensus buy for everyone. Where will the fresh appetite come from?
So if you look at it, Nikunj, I think there's been pretty meaningful reduction in institutional exposure, both FII and DII, to HDFC Bank ever since the merger was announced with HDFC Limited. So over the last 1.5 years, institutional exposure has pulled back, which is why the price to book has come off from 4 times down to 2.2, 2.3 times. And the institutional sell-off has been driven by this point of view that the merger will be difficult to execute, that something on this scale has never been done before in Indian banking. And in parallel, the PSU banks have posted good results. So there have been other alternatives for institutional investors to load up on India. So that's so that's where, if you say it's a consensus buy, I appreciate for brokers it might be, but on the buy side, there's been on the institutional investment side, there's been a fair bit of selling. My reading is that selling abates, and as the company stabilizes, as the numbers stabilize, we will see institutional appetite returning. Remember, merger synergies haven't yet kicked in. Without merger synergies kicked in, HDFC Bank is doing around 1.9% ROA. If that trickles up to 2% ROA, assume gearing of 9 times. This is an 18% ROE bank. We're looking at an 18% ROE bank, even without meaningful merger synergies kicking in. And an 18% ROE bank growing consistently at 20% at this scale. We don't have too many other lenders operating on this scale at this level of profitability anywhere in the world. So I reckon investors like us have to stay patient. Operational delivery post-merger has been solid by the management team. They're doing a good job, and we'll stay invested here. And I think other institutional investors will see the logic of coming back to HDFC Bank at what are mouth-watering valuations.
Patience will be the key, Saurabh, right? Sabr ka phal meetha hota hai. I think we should start saying that for HDFC Bank. Okay, I'm going to shift gears and talk about the health of the market. We are off to a good start. Markets are certainly not worried about budget. Nobody's talking about elections. Everyone is saying Jai Shri Ram, right?
It's vote on account, so one shouldn't buy a vote on account. And you're right, political stress has been taken out of the way by the assembly election results. Where I think the degree of optimism that I'm seeing kicking in, leaving aside budget and the political outlook, where the optimism actually is warranted is the interest rate outlook genuinely is positive, both in India and in the rest of the world. I know events in Middle East are a little worrisome, and if the rebels and the Houthi rebels and the Israel situation flares up, perhaps oil goes back up again. But leaving aside the Middle Eastern concerns, the interest rate outlook is positive for the country. The growth outlook is positive. Political situation is stable, and therefore on all of those fronts, the optimism in the market is warranted. Small cap valuations do look completely out of sync with reality, but large cap names such as the one we've been discussing this morning, Nikunj, the large cap end of the market, I don't think valuations should raise concerns.
Have you trimmed your position, Saurabh, on any of the mid or small caps that you own?
No, so we continue to be invested broadly in the same set of stocks. Where incrementally we're becoming more comfortable is in the sector which gave us the most pain in 2023. I think, as is well known, we have been large investors in specialty chemicals for several years now. It worked for us for 3 years. Last year, we were absolutely hammered in spec chem because the Chinese dumped chemicals all across the world and in India from May through to October. The Chinese dropped prices of chemicals by anywhere between 30 to 50%, and that hit our investee companies there. November, December, the Chinese seem to have throttled off on dumping. The import data is encouraging for India in that regard. And ironically, with these shipping rates going up, right, shipping rates, container rates seem to have doubled in the last month because of the situation, the terrorist situation in the Red Sea. That implicitly acts as a deterrent on Chinese dumping because the shipping rates go up. It gives a degree of protection to Indian spec chem manufacturers. So we're looking forward to the spec chem manufacturers publishing decent results for the quarter to December, and hopefully, giving the world a little bit of optimism for calendar 2024 in terms of respite from Chinese dumping. We remain big investors in the sector because we believe the China plus one story in chemicals is massive, and we would rather keep loading up on spec chem names at very attractive valuations rather than wait for the uncertainty to abate and then the valuations just rip through. So spec chem is a sector where incrementally we're becoming more confident about the outlook, and therefore names like alkylamines, GMM, Pfaudler, where we've had large holdings, we're staying constructive there.
What about some of the compounders in the portfolio, the likes of Trent as well, Fifth Tata Group, incidentally, to top the 1 lakh crore market cap? How do you see that as a performer along with an Astral?
So on retail, it's very interesting what's happened in Indian apparel retailing. It's become a very demanding market because of the rise of online and how online and social media has shaped tastes of the Indian consumer. If you're a run-of-the-mill apparel retailer in India, not on the cutting edge of fashion, you don't have sharp pricing, I think you're finding life very difficult. And I think we'll see that in the Q3 results. Run-of-the-mill apparel retailers are finding the going really tough. All credit to the team at Trent, Noel Tata, Venkataslu. What they've created is very impressive. Not just the West Side proposition, which is a familiar proposition for middle-class shoppers, but the Zudio proposition is very, very interesting. I've traveled to now, I think, 40 Zudio stores in various parts of the country. Fashionable clothes, attractive price points, constant refresh. Every 7 days, the lineup is getting refreshed. And if Trent keeps scaling Zudio from roughly 450 stores currently to say 2,000 stores over the next 3-4 years, I think this becomes a massive compounder. Zudio becomes a massive compounder for Trent. And then in parallel, Star Bazaar, we've been visiting stores consistently across the country over the last 5-6 months. We think Star Bazaar 2 is a very disruptive proposition. It's a very different type of grocery retailer to what we've seen in India. And we think the format works. We are seeing stuff fly off the shelf at Star Bazaar. We reckon that's on the cusp of profitability. So on our numbers, this is on somewhere around 50 times earnings. And we think the combination of Zara, West Side, Zudio, Star Bazaar, you've got a quadruple play there, which could make our clients a lot of money in the years to come. So both in consistent compounders and in rising giants, this has become an increasingly large position for us.
Sort of not an apple-to-apple comparison, but that also brings me to the next end of the curve. And, Nikunj and I often have a discussion about models like an Avenue Supermarts. They're really struggling, right? Because what's holding up well is the entire K-shaped recovery theme, the urbanization trend. Where does it leave models like Avenue?
So I think there's positives there and perhaps a couple of things there for management to think about. We're not shareholders in Avenue, so all the other names that I mentioned, I'm invested through Marcellus PMS, so are my parents, and so are our 9,000 clients. In Avenue, we're not shareholders, but it's an impressive business model. As you're alluding to, Aisha, the groceries piece I think is fine there. The FMCG piece is fine. Where they've had a bit of a challenge over the last couple of years is what they call the hard lines, so merchandise, clothes, curtains, pots and pans. And the reason for that, as I say, the reason I think it's becoming harder for an Avenue to sell clothes is the budget buyer, the buyer who purchases clothes of 400, 500, 600 rupees, that budget buyer of apparel has become very discerning. And therefore, you can sell clothes to the budget buyer, but your positioning has to be pretty sharp on the fashion front. If Avenue can upgrade its buying and refresh the lineup of clothes and Avenue stores in DMarts, if the lineup of clothes that we see in DMarts is refreshed and made sharper, I'm sure they'll see improvement in their operating margin, because the operating margin gets dragged down. The margins get dragged down if you sell fewer clothes and fewer hardline merchandise at the DMart stores. That's where the struggle has been. Radhakrishan Damani ji is a legend. Neville is a super CEO. So they've got smart people. I'm sure they will try to figure out how to get their apparel sales revved up. And Zudio is a perfect case study right in front of them.
Saurabh, let's look at two stocks then. We've discussed HDFC Bank, the other one is TCS. You've owned it and you've liked it. Now there seems to be a early recovery which you can look at IT. At least the managements are sounding confident that worst is behind us. So is HDFC Bank, which is a contra and a value buy, is that a better bet, or is TCS a better bet given that the industry now after 18-24 months of a gut-wrenching contraction is now turning?
So I think if you look at the two stocks, Nikhil, TCS and HDFC Bank, TCS's business has operating levers, but then this is not an industrial play. So TCS is an IT services firm. Operating margins are super healthy anyway, around the 25% mark. And yes, as the big order book, I think it's a $10 billion order book, as that comes through, the EPS growth, which has sort of gone down to low double digits, perhaps even single digits in some quarters, the EPS growth reverts to the long-term normal of 15, 16, 17%. And TCS therefore should have a good run as the Western economies recover over the last couple of years. What TCS hasn't had is a massive derating in valuations. HDFC Bank has had that. So with HDFC Bank compared to TCS, you're potentially looking at 20% earnings compounding and a re-rating, whether you use price to book or PE, doesn't matter. So you get a double play on HDFC Bank, 20% underlying compounding in the business as opposed to say TCS is 16, 17% and a powerful re-rating. And therefore in our portfolios, the HDFC Bank position is much, much bigger than the TCS position.
Okay. How do you see 2024 being different from 2023? Largely because of macros and moving parts like inflation and interest rates.
So I think the first big difference is we are optimistic that the private sector capex story revs into high gear. Private sector capex really hasn't done much in India since FY19. All the heavy lifting has been done by government capex, which is roughly tripled by our estimates since FY19. Now, private sector capex plays are very different from public sector capex plays, and therefore, say in our portfolio, we have names such as RHI Magnesita, which is a play on the steel demand in India continuing to run up, and all the steel plants in India needing more capacity to be installed. Similarly, Grindwell Norton is a play on private sector capex. It's an abrasives provider. So the public sector capex providers would be, say, the public sector capex beneficiaries would be cement, EPC companies. They have had a tremendous run over the last couple of years. Our reckoning is private sector capex ka time aa gaya hai. The second areas, as we were discussing, IT services. We also own engineering R&D companies like Tata Elxsi and Tata Elxsi and LTTS. The ER&D companies and IT services companies have had a rough couple of years. As the Western economies recover over the next couple of years, we should see better numbers come through from LTTS, Tata Elxsi, Infosys, TCS, and so on and so forth. And the third area would be private consumption. Private consumption actually has been pretty weak in India. The latest GDP print, private consumption was growing at, I think, 3 or 4%, which is unbelievable in the Indian context. I reckon private consumption in India will pick up as the private sector jobs market and the interest rate cycle moves in the right direction. So consumption-related pays, we just discussed Avenue. Consumption-related pays in India have had a tough time over the last couple of years. Aisha alluded to the K-shaped recovery. I think several of those issues could be less painful in 2024 than they were in 2023.
Saurabh, thanks so much for joining in, discussing, of course, HDFC Bank and then stocks across your portfolio. Good to have you on board. Status check on the markets then, and as things stand, we're looking at a level of 21,816. We're down 1%, 770 points shaved off on the Sensex, and you've got the broader markets in comparison far better off. HDFC Bank, of course, remains the biggest casualty. It's down 5.8%, massive weightage. That's dragging the overall index down, and it's taking down with the names like Axis Bank, ICICI Bank. You've also got some of the auto names that are under pressure, metals, likes of Kotak Bank, Adani Enterprises, JSW Steel, etc., all down and out in today's trade. But let's put the spotlight then on earnings, and you've got L&T Tech in the spotlight on the back of their earnings. You've got the revenues, which came in higher by 1.5% sequentially. They signed $10 million plus of TCV deals in Q2. Amit Chadha, the MD and CEO at L&T Technology Services, is here with us to discuss numbers. Thank you so much for taking time out. Let's begin by talking about the overall growth rate, because that has slowed, from the 6% plus that we saw per quarter 8 to 9 quarters ago to about 1%. Are you confident that this is the bottom and hence a sharp reversal can be seen in Q4?
You were to do the math and you look at 17.5 to 18.5, you will realize the asking rate is about 4%. So I am confirming to you that quarter 4 will be a good quarter, and that's how we are reaffirming our guidance. And I have confidence based on the deals that we have won, based on some of the deals in play, that we will be there as we move forward. I'm extremely excited about the kind of opportunity that exists for engineering services with India Inc. Globally. So fairly comfortable at this stage.
Right, I just want to further drill it down on that point that you made. At the upper end of your guidance, the Q4 ask rate is 8% QOQ. Is that realistically possible?
There is no miscalculation here. There's a range here. And that's why I told you that the lower end puts you at above 4% and the higher end puts you above, of course, higher than that. And we continue to work on it as we move forward in the year and in the quarter, and we'll keep you updated.
Right. So you're on track for the guidance, but any color, would you be close to the upper end or the lower end of the guidance band?
I would not comment at this stage. All I will tell you is we're working towards it.
Okay. Has the contribution then started from BP deal in the third quarter? And if yes, how much was the impact? Also the kind of scale up that you're expecting in the next quarter?
We don't, shall I say, weigh on specific client contributions in a quarter, but I can tell you that the work with BP has started. We have a short-term, medium-term plan. We are working together on that. It's a relationship. And the teams have already started working on it, and we do expect this team to steadily scale up over a period of time, and there will be contribution from BP towards revenues in the current financial year as well as next financial year.
Okay, a word on your margins, because despite no wage hike, there was a bit of a subdued margin performance. Can you walk us through the outlook in terms of the various headwinds and tailwinds that are at play here when it comes to margins?
Sure, thank you. Thank you for asking that. So number one, margins, I'll give you some quantified answer here. So 336 crores PAT, up from 297 crores same quarter 1 year ago. So up about 13.4% year on year. If I look at quarter on quarter in terms of PAT, gone up from 336 crores from 315 crores. Again, an increase of 6.6% quarter on quarter. So I do believe there's been an improvement. Gross margins have improved for us, but we continue to balance between operating expenses as well as investments that we continue to make, because we are a technology and engineering business rather than a generic business. So we need to continue to make those investments. In fact, I'm happy to share with you that we have filed 53 patents in Gen AI with medical, transportation, and regular software-defined use cases. And all this requires effort, requires compute power, requires investments that we continue to make as an ongoing business.
Right. Okay. So in terms of headcount as well, there was a net headcount decline this quarter, right? And will this trend then of a decline continue in the next quarter as well, or are we likely to see a positive number?
So we did on purpose. We did not backfill the attrition we were having. In fact, our attrition's come down to 15.8%. So on purpose, we did not add the headcount because we knew this would be a kind of a soft quarter for us at about 1% growth. But we are actively adding. There are new joinees that have joined us right on 2nd of January. And I do expect they will be fully operational, billable for us in the current quarter. You will see net headcount increase in quarter 4 and beyond from here. I also want to add two more things. Number one, we have been taking about 2,000 freshers. Every year, we've been making offers to about 2,000 freshers. This is the third year in a row we have done that. And our last bit of committed freshers will join us in the current quarter. And for next year, we've already handed out 1,200 offers in campuses. And we continue to look at campuses for further hiring. And we are stealing up those numbers and firming up those numbers as we speak and as we move along.
Right, and between plant engineering, telecom, transport, high-tech, etc., which segment is it that you think is going to drive your growth over the next 6 to 12 months?
So I would say digital engineering, which is digital manufacturing and digital products and software as number one. I would say transportation equally there and plant engineering. So I would clearly call out these three as winners as phase one. And then I would put high-tech as well as medical, if I may, in the second phase, if I may do that. In fact, I would turn things around and say this to you that if I look at our results for quarter three, we've actually all 5 verticals for us grew sequentially quarter on quarter, second quarter in a row, right? In fact, medical was at about 2% and transport and telecom came in at about 1% each. Europe and industrial products, so Europe is a region and industrial products as a segment hit a $200 million run rate for us annualized in quarter 2, right? So I do believe that we did fairly well. Not just that, in terms of deal wins, also the velocity has been similar to the last quarter. There were 6 wins, more than 10 million. In fact, one of them was a 40 million deal in the comm space. The second was a $20 million deal. And then there was a 10 million in cybersecurity. I want to call that out because there was a lot of, shall I say, apprehension as we had bought Smart World. So we've been able to take it global. And the cyber deal is a global deal from a global customer that we've been able to win.
You had aspirations to hit the $1.5 billion mark by FY25. Is that on track?
So we continue to be, that was an aspiration that we have, $1.5 billion revenue run rate. Yes, the aspiration still holds. Current year guidance, 17.5 to 18.5 holds. Does CY24 look better than CY23? I would think so. Born optimist.
I also wanted to hear your thoughts on North America. Given that growth, it seems like growth again has been led by Europe. Any signs of turnaround in United States?
So when you look at our results basically give you by currency, billed currency. They don't really give you by region, they give you by billed currency. So it could be slightly misleading. I would like to confirm to you the highest growth that we have had in the last 2 quarters has been from Europe. Our North America region has also grown in both these quarters and then has been ROW. And I would like to confirm that that's the case for quarter 3 as well.
Okay, great to have you on the show. Thank you so much for taking the time out and speaking with us and flagging off what the quarters ahead are going to look like. That, of course, was Amit Chadda, MD and CEO at L&T Technology Services. I want to quickly revisit what the market is settled in at before we move forward and welcome on board our next expert. We're 1% lower on the Nifty. We've clearly breached that 21,850 level in the Nifty futures as well. And today's movement and price action, you could solely blame it on on HDFC Bank, which is still lower by 6% on the futures. There's, of course, SAIL, Jindal Steel, Hindalco. Metals are the ones which are really weighing heavy. Surprisingly, the one sector which has jumped back into the green is actually IT. So Infosys, TCS, LTIM, TechM, they're all the ones which are bunched up as amidst the top gainers on the index today. Of course, due support coming in from heavyweights like an L&T as well as Reliance Industries as well. Less than 0.5% of a move, but they're definitely providing that cushion to the index at a time when clearly banks are not. And by the way, it's not just HDFC Bank. Axis as well is lower today. There's Kotak Bank, ICICI Bank, which are due to report their numbers later this week. They're both lower by about over 1% as we speak. But another set of earnings to discuss, and let's welcome on board Rohan Verma, the CEO and MD at MapmyIndia, joining in on the show right now. Rohan, hi, morning. Good to have you on ET now, and congratulations once again. Your overall numbers clearly have been largely in line with what the street was anticipating, but quite the strong performance actually in the consumer tech and enterprise and digital transformation and IoT segment. What's leading to this kind of growth for you?
Thanks a lot for having me on the show. In general, we've had a pretty large open order book, and I think our team has been executing well when it comes to our different segments. As you rightly said, C&E has grown 70%, quarter on quarter. Year on year, it's up 43%. But A&M is also doing quite well with multiple go lives across four-wheeler, two-wheeler, IC and EV, and video telematics for fleets, or enterprises, new age tech companies, and private industry across industry verticals. IoT has also seen a 62% healthy growth. And if you look at the overall margins, Mapland is 54, 55%, and IoT has grown 6.2 to 6.3 to 8.2 to now 10% every quarter. So it's in line with how we've been planning. We're happy with how we're executing, and the overall year is looking quite strong.
I have a very simple follow-up question. How is MapmyIndia different from Google? Are you gaining market share from Google? If I look at private commuters, they still use Google. But if I look at public commuters, let's say Swiggy or let's say Zomato, or for that matter, taxis, they've started using MapmyIndia. What is changing at that dynamism at retail level?
Sure, Nikunj, I mean, if you look at our B2B business with the suite of offerings that we give to automotive OEMs, what we call NCase, I don't think Google is a player there when it comes built into solutions. And even when you look at the C&E market, consumer tech and enterprise digital transformation, the suite of offerings that we have around geospatial analytics, IoT, field force management, Google is not a player there. So when it comes to B2B, I think we have a much wider breadth of offerings. And also the map is far more accurate and detailed. It's not just a 2D map, it's 3D, high definition, 360-degree, and a lot more Indian features. The one place obviously Google has been historically very strong is B2C, with consumer using Google Maps app. And I attribute it to the monopoly they've held in terms of being preloaded on Android. Things are changing now. In the last 6-9 months, you must have seen our B2C app, Mapple's app, really skyrocket in terms of usage. We've displaced Google Maps as the top app on the Apple App Store and Google Play Store for many times over the last 6 months. And a lot more people are using it. A lot more people are talking about it on social media. And it's down to some Indian features like 3D junction views so that you can climb and avoid a flyover, or speed camera alerts, or road speed alerts, or the toll cost. And for example, when the Atal Setu came up in Mumbai, immediately it was there on our map, and the other maps kind of were laggards on that. So I think we're differentiating on product, competing toe to toe, and winning share, not just in B2B where we are anyways ahead, but on B2C, which somebody would have found impossible to believe.
Your B2B business, I'll divide it into two. Enterprise customers and government. Can you share with us that what is the growth in both these individual business segments?
Sure. I mean, government is a small part of our portfolio. It's 5 to 10% in that range. It's very good that the government has a digital transformation agenda. We are very well positioned as an OEM, a product and platform company in this space. We work with many SIs, and some of the flagship projects of government is where we are built in. For example, the Viksit Bharat campaign that's happening right now, where trucks are going everywhere across the country and a portal is there so that people can see what schemes belong to them. We are the mapping and IoT provider there at scale. Similarly, if you look at the road construction projects, our IoT solutions are there, or urban development, or in defense also with our solutions. So I think government, we are doing quite well. But obviously, enterprise, private sector, the largest new age tech companies in e-commerce and fintech, or the largest banks, or logistics companies are all our customers.
You always told us that, look, I'm not an IT service company. We are not like a QS/QT story, not quarter to quarter. But look at annual numbers, look at our growth numbers. The fact that margins have gone below 40%, is just seasonality at play, or 40% will be a tall order now going forward?
No, our margins are 42, 43%. I'm not sure where this number of lower than 40%. EBITDA margins I'm talking about. EBITDA margins, anyways, we've always said it's going to be 40% plus in this year, and we are holding in that. It's 42% in Q3 and 43% year on year. Year to date. And PAT margins are a healthy 30% plus. I think it's quite a strong performance. And I don't know many companies who have that in the tech space in India or otherwise.
You would say that, look, we are growing, but the base effect would kick in. Are you really far away from the so-called base effect, or base effect will kick in a year from now?
I think we've put out the goal that we have for FY27, FY28, which is crossing 1,000 crore plus milestone. We've pretty
bottoms up explained, where we are when it comes to new vehicles which go built in from the factory. It was 1.9 million last year. Most cars come built in with our solutions, and even now two-wheelers are adopting it, or 1.9 lakh devices in the aftermarket, or in the order of 800 customers in total that we have, and a few hundred who are at scale contributing to the C&E business, and how we want to, over the course of 4-5 years, I think there's a large headroom of about 8,700 crores worth of opportunities specifically, out of which we're targeting 1,000 crore plus. I think we see that, next few years, a 35 to 40% CAGR, if you look at a 4-5 year horizon, is very much possible, and that's what we're working towards. And I think our track record last 7-8 quarters since we've been public, showing this consistent growth with high profitability, I think is testament to kind of how we've been executing and what the outlook looks like.
Summarize the last answer. That you expect a 35 to 40% CAGR growth for 4 to 5 years with margins in and around 40%. Will I be correct?
We haven't put out a margin guidance, for this year, we put out a margin guidance of 40% plus. I think for us, it's important. We've hit about 116 crore of EBITDA, about, in the order of 100 crores of PAT in the first 9 months. So given we're a product and platform company, given that map-led and IoT-led, map-led margins are high, IoT-led margins are increasing, we believe, of course, that we'll continue to be a strong, profitable company. And, but the focus is also on growing the business. And as a product platform, high margin business, I think those things will also follow.
Anything exciting which MapmyIndia is doing when it comes to Ayodhya? Anything exciting which you can share with us?
Super exciting. If you look at over the last year, we've collaborated closely with UP Police to improve traffic flow and road safety in the state of UP. Even in Ayodhya, there'll be a lot of traffic and road closures when it comes to the ceremony that happens next week. And again, we're collaborating with UP Police to be able to guide citizens, commuters, as to where the closures are. I think we are working very closely with them, like we did with G20, in the G20 with Delhi Police. Also, we put out this really amazing digital twin, metaverse, realverse, what we call, for Ayodhya, which anybody can already experience through the Mappers app and mappers.com, where you can see the Ram Mandir and other very big mandirs and landmarks in full kind of immersive 3D. And finally, like one interesting thing that you can do is on the map, in all the mandirs, we are putting diyas as symbols. And people can also post a diya with their wishes, in celebration, in an online, digital, unique way of celebrating this great milestone for the country and for the community. I think these are pretty unique Indian ways of kind of celebrating, collaborating. And we have a great kind of Ramayan map from Treta Yuga, a print version with a QR code for kind of this metaverse kind of immersive experience. I think that a lot of people have been putting in their homes, in their mandir areas, in their drawing rooms. So I think bunch of interesting things. We're also kind of, excited about, happy about the country's cultural kind of renaissance.
Okay, that sounds pretty exciting. Thanks so much for taking time out and joining in. That's the word coming in from MapmyIndia. The stock price, though, under a bit of pressure in today's trade at 2000 levels. But the stock price of ICICI Lombard is actually holding out quite well, despite the fact that it was a bit of a miss in Q3. Let's connect with Gopal Balachandran, who is the CFO and Chief Risk Officer at ICICI Lombard, joining in. Thanks so much for taking time out. To begin with, the motor segment, that has seen quite healthy growth, and that's largely been aided by strong two-wheeler, private vehicle and two-wheeler sales. What's your outlook? Will this sustain?
So I think that's a good question to start off with. I think as you rightly mentioned, I think if you look at the market environment in the context of auto vehicle sales, across segments, I think we have seen a lot of positive momentum getting played out. For example, which is what we had put out even as a part of our analyst call that we had last evening. If you look at it on the private car side, for example, I think we have seen almost close to about 3 million vehicles getting sold. On two-wheeler, we have seen for the market almost close to about 13 million vehicles getting sold. And on the commercial vehicle side, almost more than 1 million plus vehicles getting sold. So in that sense, I think the market momentum seems to be very, very positive. Which in that backdrop is where when you look at it in the context of ICICI Lombard for us, even for us, I think the growth momentum has been quite positive. And in fact, for the month of December, we have actually kind of gained market share. The industry grew at about 8.8% in overall motor. Our growth in motor was almost about 10.8%. And therefore, when we look at heading into Q4, I think we are very, very positive in terms of the opportunity that the segment presents. And we have got all the right levers in terms of distribution, service, and technology, which should aid us to kind of sustain the momentum that one is seeing in the context of motor.
You mentioned that you've been losing market share until December 2023. You have indicated early signs of that easing out. Will you be able to gain market share going forward? How much and how would pricing actually pan out also for you going forward?
So again, I think we'll have to put that into context. So the thought process of what ICICI Lombard historically has been to kind of drive profitable growth as a theme. And whenever we have seen elevated levels of competition play out in the market, we have always been taking a bit guarded/cautious approach to writing risks. Which is why in the last couple of years, when motor as a segment had seen elevated levels of competitive intensity getting played out, we obviously calibrated growth, and that's the reason why we have been a bit lower than insofar as market growth is concerned. If you look at the industry numbers, which is available obviously at a quarter's lag, the first half year numbers, reported numbers for the overall market seems to indicate possibly anywhere between 4 to 6% improvement in the loss ratios of motor as a category. So hence to that sense, there seems to be some early signs of easing. And it is in that context is where I kind of talked about to say that we are very, very positive in terms of the outlook that one is seeing in the context of driving motor in terms of its growth. And while you will see in the aggregate for us, possibly, as I mentioned, maybe a lower than market growth, but the relative difference between industry growth and ICICI Lombard has been coming down every quarter. But as I said, for the month of December, we have actually been able to grow faster than the market. On the loss ratios, I think it could be a combination of either pricing getting better, or for the matter of fact, I think the relative cost of acquisition that one incurs in the context of the expense of management guidelines is something also which players in the market will have to calibrate. So those are 2 points that one will kind of watch for. As of now, early signs, but obviously we will watch for the trends to play out. But the momentum, as I mentioned earlier, looks to be very, very positive.
Okay, and tell us a little bit more about the health segment. Growth was a little slower in retail health. Is that a conscious effort? Any targets you have in mind?
I think so. Let me put the numbers in context. I think you're absolutely right. When you look at health as a category, that's been again a preferred one. Whether you look at the corporate health or whether you look at the retail health in terms of both the segments on the health side. If you see on a 9-month basis, the industry grew at roughly about 21-22%. Our growth has been slightly in excess of 29%. So we have had a significant outperformance in terms of growth. And even in the Q3, for example, the industry grew maybe slightly lower at about 15%. Our growth has been in excess of 24%. So we have always had a significant outperformance in the overall health portfolio. And within that, your point on us growing, let's say, relatively faster on corporate health in the context of retail, I think again, when you look at in terms of the market opportunity, both of the segments are preferred segments for us. We have definitely seen improvements in pricing getting played out on the corporate health side as we speak. And therefore, we have been kind of rightfully capturing the opportunity of growth in that segment. Retail health for us is an area of investment. We have not been actively investing in the past, but over the last couple of years, we have been significantly making the right investments in building distribution. And that's the reason why relatively the growth for us has been slightly lower. But it is pretty much, if you look at even retail health as a category, we grew slightly in excess of 19% on a 9-month basis. The industry numbers would have been slightly lower than 19%. So in that sense, we are actually trying to grow faster than the market. But that's an area where I said we are continuing to make investments in expanding distribution, equally significantly kind of excelling service capability and creating the right product portfolio. So hence, one would continue to see the momentum play out both on corporate health and retail health, as both of them are preferred segments of opportunities.
Right. And how do you see your net loss ratios play out in the motor as well as the health space? And how comfortable are you on risk?
In the context of our own experiences on motor loss ratios, again, it is within the range that we are comfortable with. Motor as a segment has got two sub-segments, motor own damage and motor third party. If you look at reported numbers for 9-month, motor own damage loss ratios were roughly at about 65%, and almost a similar number is what we had seen on the third party side. The range that we are comfortable with operating on motor loss ratios on own damage, for example, is between 60 to 65%. And on third party, we are comfortable operating at a range of 65 to 70%. So the overall book should operate at anywhere between 65 to 67. So in that sense, I think we are quite comfortable within the range at which we are operating at. And also, I think we end up doing a lot more in the context of claims management. That's an area of focus that we significantly focus on. And hence, to that extent is where I think we are comfortable with operating in the range of 65 to 67% in motor as a category, insofar as the loss experience is concerned. On the health side, I think the loss ratios could vary depending on whether you are making your offerings to a corporate or whether you're making your offerings to a retail customer. On the corporate side, I think even in the past, when we have kind of spoken to the channel, we have talked about the loss ratios on the corporate health side in the range of 94-95%. And even if you would have looked at the 9-month numbers reported for us, the number has been at about 95%. On retail health indemnity, we have talked about us being comfortable in the range of 65 to 70%. And for the 9 months, the retail health loss ratios has been around 66% or thereabout. So on both the segments, I think given the opportunity that one is seeing in terms of the positive momentum on growth, but equally given the focus that we have in terms of the loss management or claim service capability that we are creating, I think we are quite comfortable with the loss ratio ranges that we are operating at.
Combined ratio is at 103, almost 104. This is much better than what the street was penciling in. Could you reach a number of 102 earlier than what you had guided for?
I think it's again a great question. So I think this has to be again looked at in the context of the market. So if you look at just to kind of refresh, market numbers are always at a quarter's lag. The industry combined ratios for the overall industry is at about 112%. It is in that context is where you see ICICI Lombard's combined ratios at about 103.6%, let's say for Q3. Obviously, if the market improves, the ability of ICICI Lombard to obviously exhibit a better outcome is always there. And that's something that we actively look at and work towards directional change insofar as improvement in combined ratios are concerned. Even the reported combined that you see, whether it is for Q3 or whether it is for 9 months, this year, relative to what we have seen as catastrophic events play out in the previous year, we have had pretty much a cat event or a flood event in every quarter, which is why we also put out separately the impact that we have seen on account of flood losses. So for the 9 months, we had an impact on floods of almost close to about 1.37 billion rupees, as compared to, let's say, just about 28 crores impact that we had seen in the 9 months last year. So even if you were to kind of factor that out, the combined ratios would have been much better at even 102.3% as against 103.6% for the quarter. But your point on, can we look at, let's say, accelerating the thought process that we have put out to the market of getting to a combined of 102% by the end of FY25? As of now, I think we are sticking to that number. But obviously, I think we will come back maybe in a quarter or two, depending on how we see the market environment play out. Definitely, we will not let any of the opportunity loose, whether it is in terms of growth in revenues or, for the matter of fact, the improvement in combined ratios or profitability that we can exhibit for the company as a whole.
All right. And could you walk us through and tell us some of the details of the new product launches, any particular segments that you target?
Home insurance will be clearly a significant area of opportunity that one sees in the context of driving growth. If you look at globally, liability insurances play a very, very critical role, and they kind of contribute to a very large proportion of the property and the casualty market. In the Indian market, again, what we're getting to see is a lot more digitization and technology initiatives play out. In that context is where you also possibly get to see a lot of risks resulting from the digital transformation that we're doing as a country as a whole. So therefore, to that extent, you may possibly get to see some of the liability insurances, cyber liability, for example, could be an emerging product that could again see a huge prospect in terms of the opportunity that one is exhibiting. On health, I think we are continuously kind of working on improving the entire product stream to make sure that we have a product that kind of largely caters to different customer requirements. It could be either in terms of the various age groups, it could be in terms of the lifestyle that one leads, etc., etc. And therefore, continuously something you may get to see us coming back to the market and informing from time to time in terms of some of the new products that we want to launch in the context of the health offering as well. On motor, I think what we did maybe last year was we kind of introduced almost about 3 offerings, which was primarily to kind of say that you can pay based on the distance or the miles that you're driving in terms of the premiums that you pay, unlike a standard premium that you pay for a 1-year risk. So here you kind of pay for the distance of travel that you do, and correspondingly you pay a motor premium corresponding to that. Or you could pay a premium based on your driving scores or driving attributes. So that's basically a pay as you drive. And finally, we also kind of launched what we call as motor on floater. Many a times you get to see a customer having more than one asset. So a motor on floater helps you to kind of combine both individual offerings into one single insurance policy. And in the process, it stands beneficial for the customer.
Right. So IFRS norms will be implemented from FY26 onwards, right? Do you expect to see an improvement in profitability on account of this?
We are in the midst of kind of doing the financial impact assessment of what would it entail insofar as transitioning to IFRS is concerned. But broadly, what I can talk about is there are 2-3 key changes that one is likely to see when you move to IFRS. One is in the context of the acquisition costs that you incur. Under the current Indian GAAP guidelines, all costs that you incur for sourcing of a premium or a sourcing of a risk, they get expensed out immediately. Whereas in the context of Ind AS or IFRS, your acquisition costs will be allowed to be amortized over the contract period. So hence, in that sense, that's a positive in the context of if you were to look at it vis-a-vis the current Indian GAAP guidelines. The second element is some of the on the claim side, there are certain lines of businesses where the development of claims or development of losses happen over a very long period of time. So, for example, motor third party. Now, there again, while you're required to pay for a claim over a longer period, but under the Indian GAAP guidelines, you are required to provide for reserves on a nominal basis. You are not allowed to do any discounting of reserves. As you transition to IFRS or Ind AS form of reporting, you may be allowed to discount those reserves as well, particularly for the segments which have a very, very long tail of claim development. So that's again positive if you look at in the context of relative to the Indian GAAP guidelines. And the third is in the context of investments, where currently the Indian GAAP guidelines do not require us to do a mark-to-market insofar as the P&L is concerned, whether it is for the equity portfolio or whether it is for the debt portfolio that we have. So hence, in that sense, there is no mark-to-market impact. Any profit or loss gets reflected only on actual realization of sale of those securities. Insofar as Ind AS or IFRS is concerned, we will be subject to mark-to-market on the investment portfolio. Hence, to that extent, we may have to come back to the market every quarter and explain the performance impact, if any, consequent to the mark-to-market that goes through the P&L earnings.
All right, thanks so much for taking time out. Good to have you on board. That's the word coming in from the management of ICICI Lombard. Positive momentum across the board. Price improvement as well is playing out, and they have started investments in retail health. The stock price, as we speak, is holding out at 14.29. But let's shift gears completely then, and the talk of the town, of course, is the transformation of Temple Town with respect to Ayodhya, as tourism for religious purposes has clearly taken center stage. To discuss this and lots more, joining in, we have Samujwal Ghosh, CEO at the House of Abhinandan Lodha, as well as Prashant Thakur, Regional Director and Head Research at Anarak Group. Thank you both so much for taking time out and joining in. Good to have you on board. And to begin with then, Prashant, let's just understand how we're looking at this massive real estate boom then in Ayodhya. Has there been a rise in demand? Have there been rise in inquiries?
I think after this verdict and this temple getting inaugurated, there has been a huge influx of capital interest, and many hospitality companies are taking position. So just to give you kind of an idea of the influx of tourists that is going to propel the economy of Ayodhya. So at any given point of time, the local population to tourist ratio is going to be 1:10. So that itself speaks about the volume of economic activity that is going to happen. And as a result, real estate always follows a couple of basic principles. One is, the sentiment. The one is the economic viability and the infrastructure. And all these three factors, I think, have really propelled. We have seen almost 10 to 20% fold jump in the land prices over there. And this is majorly due to the fact of now connectivity being seamless. The infrastructure is taking shape. As we speak, we have got close to 15 hotel permits by the government. 30,000 worth of investment has already gone in terms of infrastructure upgrade. And this temple town is not only going to act as an economic center, but also a cultural hub. And if you combine the entire region, including Kashi Vishwanath corridor, Banaras, and Ayodhya, I think the entire belt is going to see a massive, and it has already seen a massive jump in the land prices, interest from developers and buyers, especially hospitality. And also in the outskirts of Ayodhya, we are seeing a massive interest for second homes and scenery. So that's where we stand as of now.
Sure. Samujwal, hi, morning. Want to get you in on the discussion as well, because you're the one who's actually acquired the 300 crore rupee land parcel, right, in Ayodhya. What are the plans? What do you plan to develop there?
So, largely our land acquisition philosophy basically lies in identifying the infrastructure growth corridors of national importance, which are either naturally endowed or tourism hotspots. And as a part of the strategy, HOABL plans to invest about 3,000 crores in Uttar Pradesh, and we wanted to make Ayodhya the starting point of our journey in UP, and followed by Vrindavan and Banaras. So, as far as this specific development is concerned, we have pledged an investment of over 1,200 crores in Ayodhya, and HOABL will be developing a world-class private enclave called the Sarayu, which is supposed to be the pride of Ayodhya and within a vast expanse of 51 acres. This project will primarily include residential plots, villas, and along with high-rise luxury apartments. Actually, the coup has been that to initiate this ambitious venture, we have forged a strategic alliance with Leela Palaces, Hotels and Resorts, and together we plan to construct a luxury palace hotel at the Sarayu on the bank of the on the bank very close to the temple. This will be Ayodhya's first 100-key five-star hotel, and which will be the cornerstone of our development. We intend to invest around 450 crores in its development, the hotel's development, and the project is touted. The development of the hotel is touted to be completed by March 2028, which will be a pretty significant milestone in our commitment towards Ayodhya's economic and cultural advancement. So that's largely what the HOABL plan is to begin with at Ayodhya.
I want to establish that what has been the quantum jump of real estate prices in terms of where they have moved. What was the prices in the city of Ayodhya and what it is now? We look at city and outskirts both. I'll just use my graphic, my sheet for reference. In 2019, before the verdict, the prices were between 400 to 700 rupees per square foot. Now they've gone to 1500 to about 3000 rupees per square foot. Similarly, outside the city, they were between 1000 to 200 rupees a square foot. Now they have gone to 4000 to about 6000 rupees a square foot. Mr. Ghosh, my question is, what is affordable and what is not affordable? And where do you think the prices will settle, both in outskirts of Ayodhya and where they would? I mean, what is that watermark level at which the prices will settle?
So, to answer that question, I guess one needs to kind of understand that what are the hallmarks of this city, and therefore what are the characteristics of our development. So I think Ayodhya largely, as we would have read, there is absolutely uncertainty of clear title land, and hence the land at Ayodhya is absolutely scarce. There is a very strong spiritual and tourism sentiment which is growing. It is, it is the investment epicenter for the government, for the central government. And as far as the pricing is concerned, what we have largely seen is that the real estate prices have soared to almost 6x to 10x levels in Ayodhya in the last 3 to 5 years, depending on the proximity to the Ram Janmabhoomi temple. And as the temple completion nears and the consecration on the 22nd of January 2024, the land inquiries have just surpassed. So from a numerical perspective, at a point of time, we have, as far as our project, our development is concerned, we have received inquiries to the tune of at a pricing of 15,000 square feet and upwards for the plotted land development. And it is primarily led by the fact that and what has been the most encouraging part as far as our understanding of the demand is concerned is that because of the scarcity of clear title land at Ayodhya, the kind of product that we are developing, the establishment of the Leela Hotel within the premise of the development.
Right. Fair point. So I'm just going to encourage Prashant also on that same point. So Prashant, where do you think prices now will settle? Let me ask you a very frank question on behalf of our viewers. Given that how religious tourism has taken up, whether it's Ayodhya or Kashi, it really could be Mathura. Do you think one should look at investing into land parcels in and around the theme of religious tourism? Do you think there is money to be made? Do you think a CAGR return of 15-20% for next couple of years is expected if one is looking at buying land parcels or even buying flats in and around these religious, places? Prashant, question is for you.
I would not encourage for retail buyers for land, but yes, I think buying an apartment or let's say some kind of property which is in terms of second home, senior home is recommended, because after a certain point of time, the investing in land is, if you don't buy it in a big parcel, it doesn't make sense for individual investor. And also considering the religious sentiment of the city, I think the land that you'll see, first of all, would be sold at a very high price, and any further appreciation from here would not be as meaningful as the expectation might run. So in a nutshell, I want to be honest that we have seen enough run up. As I said, that immediately after the verdict came in 2019, we saw a price jump of 25 to 30%. And after, in the last 5 years, the prices have already shot up by 10 to 20 folds. So I think one has to be really judicious in terms of the size of land parcel is being bought, the location that it is being bought, and what is the purpose. So if you want to buy it, hold it, and just exit, I don't think it makes sense. I think for that, you should opt for some apartments or flats over there. Definitely, it's going to give a good return.
Your data is indicating that land prices have gone up by 10 to 20 times. Is that correct? Or am I missing a zero here?
In last 5 years, it has shot up.
10 to 20 times?
Yes. You see, we need to understand that, there's a huge shortage of land within the city limit. And in the anticipation of the positive verdict, the land prices had already started to shoot up. And then in terms of, I have a sentiment value attached to the land, for example, within city limit. Whatever the price was being asked initially is being transacted. So that's where the sudden spike that we have seen, and that's the reason I am a bit skeptical for an individual investor to enter. It makes good commercial sense for big hospitality companies, but I think whenever the sentiments are high, the retail investors or let's say a person who's buying for an investment point of view should exercise some caution. I would suggest let the euphoria settle down and then think of making an investment.
Mr. Ghosh, closing comments from you. The same question what I asked Prashant.
Sure.
Somebody who's watching the show, would you encourage?
So, definitely, yes. I mean, the pricing dynamics in Ayodhya is extremely unique because it's extremely supply-starved market. In fact, unencumbered land in Ayodhya, especially near the temple influence zone, is absolutely rare. Therefore, my personal belief is that wherever there is a credible proposition from trusted land developers, will always command a premium. In fact, we are seeing, in a recent government auction, bidders agreed to pay almost 1.5 lakh square feet per square meter for raw land, which is almost a 10x jump in 5 years. The bidding price was at around 88,000 square meters, and it was finally sold at a lakh per square meter as far as the pricing is concerned. So yes, the point that I would like to make here is that it makes immense sense considering the fact that the mix of tourism, infrastructural development, and the strong spiritual sentiment is going to augur great growth, even as far as the retail investor is concerned, because it is just not becoming a spiritual tourism center, but also is becoming a center of commerce because of the hotels, residential developments, so on and so forth. So land will be rare, land will be scarce, and whenever there is scarcity, it has got a direct impact as far as pricing is concerned. So, and the kind of investment, which is almost, the government intends to invest almost 85,000 crore rupees over the next 10 years. So all of this are the makings of how the city will evolve. The Temple Trust suggests that with the mandir opening, there will be almost 80,000 to 1 lakh visitors every day. I mean, Vatican City gets about 5 million visitors every year, and you're talking about almost 35 crore plus visitors every year. So those are extremely telling numbers to indicate the economic potential of the city, and thereby how it will benefit even retail investors for that matter.
Gentlemen, appreciate your time. Thank you for joining in and telling us a lot more about the Ayodhya mega opportunity. On that note, then, it's time for a very quick break. We'll be right back.
Co-powered by Century Laminates by Manish